Hello, class. I have looked over the homework for week 4, and there's an awful lot of work here, and some of you may have already completed this or made a lot of progress on it. I recognize that it might be a little bit challenging given the volume that's here, and in addition to simply working through these ratios and crunching the numbers, I wanted to record this video to help you through that process, but also to help you understand more clearly what's going on and what these numbers mean and why we even do all of this. So we're going to work through this. I'm going to try to do this quickly, and I hopefully you find it helpful. So I'm going to do all of the problems. I have changed the numbers so that it's not going to be exactly working your homework for you, but it is going to be in a format that you could follow and use in completing your homework using Excel, of course. And so a couple of things that I'm going to point out, I've added or I've changed a little bit in the problems, more or less in the way that they're organized. And in some cases, I've even added some information like you see here in red. That the only reason I did that is I want this information to be presented to you in a format that's most similar or familiar to what we were doing in the accounting module. So where they just give you 2 or 3 numbers or a handful of numbers that either come off income statements or balance sheets, what I'm doing is I'm adding to that so you can see a little bit more clearly that information presented in the formats you've seen previously. So as an example, in the first problem, they just give you revenue and net income. So I backed into what the expenses would be to create kind of a little miniature income statement there. They only gave you certain information from the balance sheet. I added to that by incorporating liabilities. And so from that, you can look at it and see it looks a little bit more like a balance sheet where A equals L plus OE, and then it balances. And so in any case, that's not a step that you have to do. I'm just presenting it that way so that it might click a little bit better in line with something that you've already learned. So let's go ahead and walk through some of these problems, or all of these problems. And in addition to just kind of showing what the outcomes are, I'm going to talk quite a bit about what these ratios mean and really kind of what is a positive ratio, what's a good ratio, I mean, and what direction would we like to see these relationships moving. And so really that's all of this ratio analysis is. None of this is for presentation to shareholders. None of this is for presentation to regulatory bodies or like tax forms or anything like that. As we move into the finance module, now we're really looking at, we're using this term financial manager, which is just kind of a broad overarching term to talk to really represent anybody within the company that has a hand in managing the finances of the company. That could be a number of different positions. And depending on the size of the company, you may have seen my response to that in one of the discussion questions. So in any case, as we work through these ratios and these calculations, this is the type of work that somebody either from the outside that's looking at lending money to this company, or maybe an investor that's looking at investing money in this company, or a manager that has the responsibility of identifying weaknesses or trends or planning for the future of the company. Each of those types of parties would do exercises like this so that the numbers make sense. So in other words, instead of just looking at revenues year over year or net income year over year, we look at numbers in relationship to other parts of the financial statements or other numbers from the financial statements. And that way it starts making a whole lot more sense to us. It's giving us information that otherwise wouldn't be readily apparent. We can track trends, we can track changes year over year, we can compare with our peers. All of these things are very important, and So that's the real purpose of all of this ratio analysis and the analytical aspects of why we do all of this. There are in any major company there are any number of people who are performing work like this at any given point in time. In my career in banking, this is probably what I do more than anything else, or at least over the history of my career. So this is really important and integral to real jobs, what real people are doing every day. A lot of ratio analysis like this, and certainly owner or manager of a small business or medium-sized business that has this skill set is going to be a much more effective business manager than somebody who does not. That's just following their emotions or their instincts. This is the type of information that is very telling about the strength of your company, its performance, and et cetera. So let's go ahead and get started. And one other final point that I want to make about that is that in just about every case, these ratios, there are different variations on these ratios. So if you go to the internet and look up any one of these ratios, you might see a different definition as to how to calculate it. So be certain when you're completing the homework that you're using the ratio formats that are presented in the book. And so don't go to the internet and say, "Oh, I see. I'm gonna use this formula instead." That very well could lead to you getting it wrong, even though it's an acceptable way, and you might be able to defend it by saying, "Oh, look, I got this off of Investopedia.com or some other website." The formulas are not carved in stone. There's different ways to look at them, and it's really that flexibility that gives them a lot of importance, because you might want to look at one company one way and a different company a different way, or one industry one way and a different industry a different way, just depending on how they're structured. So use the formulas as they are presented in the book, and that's what I'll be doing here. So again, I said I changed the numbers from what are presented in the homework, but effectively and directionally, they all work the same way as what you have in your homework. I just don't want to just feed you the answers. So let's begin looking at problem number 1, where we are asked to look at some income statement accounts and some balance sheet accounts for Star Inc. And then we're going to calculate return on equity for each year presented, 2 years. We're going to use the DuPont method, and then we're going to use the direct ROE method. And we're going to compare those two, and we're going to talk a little bit about why the firm's ROE changed, what caused the ROE, the return on equity, to change from year 1 to year 2. And so let me say first that if I'm an investor in a company, where is my money found on the balance sheet? My investment in that company is found in the equity part of the balance sheet. So anytime we hear return on anything, return can be several different measures. It can be any way that we want to define either profitability or cash flow. Generally, are the two ways that we would go about that. In this case, we're going to be using net income or revenue or different measures. So whenever you hear return on assets, return on equity, return on debt, return on capital, return on anything, you can automatically expect that the numerator, the top number, is going to be some form of revenue, net income, or cash flow. And the bottom number is going to be whatever we're trying to see the ratio of that return number, that income number, as compared to generally a balance sheet item. And so when we're talking about return on equity, this is very important to investors, because this is effectively what they would use to say, I can take my money down to the bank and I can put it in an account at the bank, and it's going to pay me some small amount, 1 or 2% maybe. That's the return on that investment. Well, if I put that same money into a business, which is much higher risk, then I'm going to expect much higher return. That makes sense. I'm certainly not going to put my money at greater risk and be happy with a less return than I could get in a relatively risk-free investment. And so, and especially because when I put my money into a business, unless I put it into a publicly traded business like on the stock market, it's not very easy to get out. I mean, I can sell stock all day long that's in a publicly traded company, but if it's a private company that I either own or I've invested in a private company of a friend or somebody, then it's difficult. It's not very liquid. I have a hard time getting my money back out. So that again increases the risk. So I'm expecting a high return. And so that's what ROE is. If I'm looking at a business and I want to see how well it's performing, I look at its return on equity. How much of a return is being generated on the equity that's been invested in this company. So here, and that's why we have two different versions. And you can see, kind of jumping to the end, you can see here that whether we use the DuPont method or the direct method, we're going to get the same number. But the DuPont method is calculated very differently. The direct method is calculated very simply, and the DuPont method is calculated very differently and allows us to use 3 different measures to come up with the same information, but now I can break it down into 3 different categories and determine what's really causing the change that I see from year to year. And I hope you can see that that's important. That's more information. As we talked about in the accounting module, all of these processes are about information and making decisions. And so we look at this data and look at the information provided in these accounts and the ledgers and the financial statements in different ways so as to be able to make better informed decisions and well-informed, good decisions. So profit margin is simply the relationship between the bottom line, net income, and the revenue that we started with. As we can see here, year 1 was 14.5% in my version of the problem, increasing to 16.4%. Do you think that's good or bad? Hopefully you can see that the more I keep, the more of the revenue that falls to the bottom line, then the net income as a percentage of revenue is increasing, and that's a good thing. That means my expenses are being controlled. I'm not letting too much get away from me in terms of poor expense management. So this shows my revenues are increasing faster than my expenses. Therefore, I have an increase in my net income and my profit margin. That's a good thing. What about asset turnover? Well, in this case, they happen to be exactly the same. I'm going to expand this just by a decimal point to see. Surely they're not. Yeah, so I have to go out to 4 decimal places to see any difference between the asset turnover. So really what this is saying is this isn't literally how many times did I sell my assets. I'm not selling all of my assets. Some assets, as you know, stay in the business from period to period. They're permanent. They're permanent accounts. And so, but this is just a measure to kind of see representatively, are in relation to my assets, how much revenue am I generating? So the higher that number is, again, the better. If I'm able to use my assets to generate 3 times the amount of assets in terms of revenue, that's much better than what we have here of 1.19 or 1.20. 1.20 is actually a pretty low number. Normally, we would like to see 2 times, 3 times, 4 times, perhaps, and or maybe even higher. So just being able to generate your assets one time is a pretty low number. 1.2 times is a pretty low number. And so let's move on to financial leverage. This is kind of a backwards way of looking at leverage. This is really looking at assets divided by equity. So that's again, think if assets equaled equity, so that number would be one time. So assets equals equity. That means I have no debt. So this version of a financial leverage number would be 1.0. If I get up to 2.0, then that means assets are twice the amount of my equity. And so just a little quick math would say, well, then liabilities must equal equity, because if equity is 50% of assets, or assets are twice the amount of equity, then what must the other 50% be? It would be debt. So, I'm somewhere between 1 and 2. I'm not all the way up to 2. So that would tell me that my equity is a little bit less of the assets than the debts. And so, if I'm a very conservative company that does not want to have a lot of debt on my balance sheet, a lower number here is better. If I'm an aggressive company that likes to use leverage and use debt as a way of generating assets, which should be income producing, then a higher number is better. But the reality is most companies will have a comfort zone where they don't want to be above that level and they don't necessarily want to be below that level. So this is one of those ratios where, to say higher is better or lower is better is not really the correct way to look at it. You really need to know the company or the industry in which it operates to have a good sense of, what is an appropriate number for that industry. So we really don't know here, but that's a pretty safe number. That's not one that would create alarm in almost any type of business. And so let's move on down to really what the question's about is the DuPont ROE and the direct ROE. And so we can see that the DuPont ROE is just this number times this number times this number gives us this return on equity calculated using the DuPont method. And when we do a direct ROE, we're simply looking at net income in relationship to owner's equity. So when I said a return is some form of a profitability calculation, cash flow, net income, EBITDA, it can be any number, any form of return that you might want to use as your numerator. Here, we're using net income. So we have 16 divided by 54, which is return on equity. So we get 29.6% that way. But when we use the DuPont method, we get more information. And the more you've heard me say that, hopefully it's starting to stick, that more information is better. So in fact, in the problem, they ask you what generates this improvement in ROE or change in ROE from one period to the next. Simply looking at the direct method, I could come up with something, but it's not going to be as informative as if I look at the DuPont method. So in the DuPont method, I look at this year versus this year one versus year two in each of these rows, and I see which one has the greatest change. So we already said asset turnover is virtually identical year over year, so there's not much change there. Financial leverage doesn't move that much, just 3 basis points, so that's not very much. But profit margin, look what happened there. My profit margin jumped really high. It went from 14.5 to 16.4%. That's a large increase. So if someone were to ask me, if I was the manager or the financial manager or accountant for this company, and said, "Wow, your ROE really went up from 29.6% to 33.9%. What led to that?" And so using the DuPont method, I can isolate that the increase in the ROE was driven by the improvement in profit margin. In other cases, I might have a profit margin that stayed the same, and maybe I managed a higher asset turnover, or maybe I improved my financial leverage in such a way that my ROE improved. So in any case, that's how we would approach that question. In number 2, we're going to be looking at EBIT and EBITDA, I believe, in this one, but the bottom line is we're going to be calculating return on invested capital. So let me just highlight all this and bring it up. Okay, so we're not getting to EBITDA yet, but we do have EBIT, which is earnings before interest and taxes. It is not interest before income taxes. Some people think the IT means income taxes. It does not. It means earnings before interest and taxes. And earnings, when we talk about EBIT or EBITDA, is net income. So we're taking the net income of an income statement and we're working backwards up the income statement, and we're adding back a couple of amounts that were subtracted to get net income. So we're adding back interest, and we're adding back taxes, and that's what EBIT is. In a moment, we'll have EBITDA, where we also add back depreciation and amortization. Some people say EBITDA. I say EBITDA. Some people say EBITDA. So in any case, here we have EBIT, which is earnings before interest and taxes, and we're trying to determine a return on invested capital. I'm gonna tell you that this is a very important number. When we look at, if we want to compare any two companies on the stock market, if we want to get a sense of what company has the best prospects for growth, or the best prospects for improving its value, this is the number that is the very most important: return on invested capital. So not only is it return on equity, but it's return on all of the capital that's been invested in the company. And your book shows a couple of different ways to calculate this number. Here we're only going to be using the net working capital and fixed asset approach. So we have our earnings before interest and taxes. I'm using 104 million or 104,000, whatever that number is intended to represent. We have a tax rate of 35%. So what we're going to do is we're going to show the earnings before interest and taxes, and then we're going to show that that portion of that on an after-tax basis. You might wonder why we add it only to subtract it, but in any case, that's just kind of how the formula works. And so we end up with an earnings amount after taxes of 68 million, and we're going to see what that is as a percentage of net working capital plus fixed assets. Now, net working capital is, you may remember from the accounting module, net working capital, or just working capital, is current assets minus current liabilities. So, and typically we would hope that we have more current assets than we do current liabilities. That's what makes it working capital. It's available for us to work with. It's not being allocated or held back to cover the current liabilities. So it's working capital available to us. And then we have our fixed assets, our non-current assets. So when we add those two together here, we have 485 million. So my EBIT reduced by the taxable amount shows 68 million. I have net working capital plus fixed assets of $485 million. So my return on invested capital, not just return on equity, but all capital, is now 13.9%. So it's lower than return on equity, but we would expect it to be. If I had no debt, then that would basically, well, my numerator is different because I'm not using just simply net income. I'm using EBIT reduced by taxes, which is effectively earnings before interest, you might say, EBI. And so I'm looking at a cash flow measure, a profitability measure. In this case, I'm using EBIT as opposed to net income or some other measure, and I'm seeing how much EBIT after taxes I have as a percentage of my net working capital plus fixed assets. So 13.9%, that's actually a pretty good number. I might want to see it a little bit higher, 15, 16, 18, or 20. 20 is really an exceptional return on invested capital as you compare, companies from the Dow indices or the S&P 500. And not all companies are comparable by this measure, but this is viewed as one of the best measures of determining future health, growth, profitability, and value. If a company is improving its ROIC, then that's a good company to consider for an investment. We don't have a problem number 3, so we're going to go straight to problem number 4. Let me bring this one up. Okay, so we're going to be looking at the fixed asset turnover ratio. And so really what we're looking at here again is the relationship. Didn't we do this in the first one? Yeah, we had an asset turnover ratio here, a form of it in the first problem. This one is a little bit more detailed, only because we're using revenue again, the top line number. That's a little bit unusual, but we're going to go with it. That's what the book requests of us. So we're going to be using revenue, and we're just simply looking at the relationship between revenue and the assets that it took to generate that revenue, especially in this case, the fixed assets, not all the assets, just the fixed assets. And by fixed assets, we mean those non-current assets, the long-standing assets, the equipment, the machinery, the buildings, the vehicles, all of those, plant and property and equipment type of assets. So we're looking at the fixed asset turnover. Oh, I spelled that wrong. My apologies. And that's going to bother me. So let me just fix that real quick. Is that right? Yep. So obviously, the higher the number, the better. We're looking for revenues to be increasing while fixed assets stay the same or are increasing at a slower pace. That would suggest that we're going to have higher profitability, higher prospects for growth, higher prospects for value. So we want our fixed asset turnover ratio to be increasing. And note here also the way that I have this laid out, because we have to use net property and equipment. I show property and equipment here when we were talking about depreciation in the last video. We note that property and equipment is maintained at its original acquisition price or cost. And so that is also called the basis. So property and equipment is still at its basis. Accumulated depreciation. Do you remember what kind of an account that is? That's a contra asset account. So the accumulated depreciation accumulates, it grows over the life of that asset to show that it's being utilized or used to generate business and effectively is going down in value because it's being used up. A vehicle with higher miles on it is worth less than a vehicle with low miles on it. The same is true of a piece of equipment. A piece of equipment that has a high number of hours of use is worth less than an equipment with low hours of use, brand new, for example. So we capture that information in the income statement by the adjusting entries that we make with a debit to interest expense at the end of every period, and we offset that with a credit to accumulated depreciation. That credit to accumulated depreciation is an increase to that contra asset account because it's a contra asset account, it has the opposite behavior to debits and credits than the asset that it or the account that it modifies, which is an asset. So as the accumulated depreciation goes up, then the net property and equipment is actually going down. What is this number? I'm not sure why that's there. That doesn't need to be there. Okay, so it's simply this: revenue divided by net property and equipment. The net being, this is the gross asset value minus the accumulated depreciation, gives us the net amount. And so the coverage or the turnover ratio is 3.48 times. Higher is better. So let's move on to 4.5. In 4.5, we're doing a lot, but ultimately this is what we're trying to get to, is really age of inventory, age of receivables, and age of payables. I can't remember if this is one. Yeah, this is one that I kind of rearranged from the way I think that the book presents it. But in any case, they give us a number of income statement and balance sheet accounts here as information. Again, I've changed all of these, I believe. And so I've changed all these numbers, but obviously the calculation of the ratios still works the same. And so these average daily sales, average daily costs of sales, and average daily purchases, in our problem, costs of sales and purchases are the same. In real life, that would not be the case. Purchases and cost of sales are not the same because I don't know of a single business that sells exactly what it purchases. Sometimes some is remaining in inventory at the end of a period. You haven't sold it yet. You purchased it, but you haven't sold it yet. Sometimes maybe you had some starting inventory that you were able to sell everything you purchased plus some of what was in your starting inventory. And so rarely does cost of sales and purchases have the exact same number, but for simplicity, we are showing cost of sales and purchases as being the same amount. That's a real leap of faith. That's not very realistic, but in any case, the math is going to work out just fine. So average daily sales is really just what were our revenues. We can tell this is for a year. Obviously, that's why it's by 365. If this was for a month or a quarter, I would have the number of days in that month or quarter there as opposed to 365. So I'm calculating the average daily sales for a year. So I have the revenues for the year, which were 512,000 divided by 365 days, tells me that on average, I was selling or generating revenue of about a little over $1,400, $1,402.74 each day. Some days, obviously, it's going to be higher than that. Some days it's going to be lower than that, depending on how seasonal my business is. Some companies are very seasonal, where they generate a lot of their revenues around the Christmas holidays. Other businesses are seasonal based on other factors like other holidays, July 4th, Memorial Day, Labor Day. I ran a business once that experienced much higher revenues on those 3 days because it was kind of tourist oriented. And so, or hotels, hotels that have high seasons and low seasons, maybe in the summer or maybe in the winter, depending on where they're located. So, and in any case, this is the average daily sales, $1,402.74. The average daily cost of sales is we look at our cost of goods sold, or here they call it cost of sales. They're calling and so we look at that cost of sales, and we're also breaking that down by 365 days. So one thing that might jump out at you pretty quickly, it's not asked for in this problem, but when we look at an income statement and we have a cost of sales or a cost of goods sold number, the top line revenue or top line sales number minus that cost of goods sold or cost of sales gives us a very valuable piece of information called gross profit. So that's just the profit we make on the goods that we sold that then must be used to cover the operating, selling, administrative, operating expenses of the company. So from what I have right here already, if the problem had asked me what is the average gross profit per day, then I could just simply say average daily sales minus average daily costs of sales tells me that my average daily gross profit is $273.97. I might look at that as compared to last year. I might look at that as, establishing a target that I want to increase that to $300 next year. And this might be in thousands or millions or who knows what. So in any case, just know that when you've got the average daily sales, you've got the average daily cost of sales, then it's super easy to calculate the average daily gross profit as well. Not that you're going to have to in any of the assignments, I don't believe so, but this is about learning. This isn't just simply about completing homework or other assignments. And so in this case, average daily purchases is exactly the same as average daily cost of sales because the problem presents it as if they were one and the same. I can tell you, let me just change this number. If for example, if this number was 450,000, let's say I had purchased $450,000 over the course of the year, but I only sold 412,000 of it. Well, where is the rest of that, right? So there's $38,000 of stuff that I purchased that's still in my warehouse. Is that good or bad? So we really don't want to see, unless our revenue is increasing rapidly, we really don't want to see this situation where our average daily purchases outstrips our average daily cost of sales by much. It's probably going to be a little bit higher, and this difference isn't that critical. But if this was, something like 750,000, I missed a zero. So if I'm purchasing $2,000 a day in stuff to sell, but I'm only selling $1,128 of it each day on average, can you see where that's a bad thing? This is one of those areas where you hear about companies that grow them, that growth is a bad thing, or that, as if I'm growing so rapidly that I have to be purchasing this much inventory every day as opposed to selling this much right now, but I have to purchase this much in anticipation of the future growth, that's very expensive. That money has to come from somewhere. So I'm only showing you this as an example of the difference between what you've actually sold and the cost of what you've actually sold versus the purchases, what you actually purchased during a year. I sold some of it, but some of it I didn't. Some of it sitting in my warehouse, and that's expensive. So I'm going to put this back to this. This wasn't in there, so I'm taking that out. Okay, so now I've got the problem back to the way that it was presented. So we've got these ratios, and we can see that we want average daily sales to be increasing. we would expect, if this number is increasing, we would expect that average daily cost of sales is also increasing. But if it's not increasing as fast as the daily sales amount, then that means I'm able to increase my selling price, right? What else would be causing daily sales to increase faster than the average daily cost of sales is only if I'm able to command a higher selling price in the market. So that's a good thing. It's probably unsustainable in the long run, but in the short term, that's a good thing. That's a good sign. So in any case, we have this information here. Now we're going to start looking at that in relationship to some of our balance sheet information. So kind of what I was talking about here, that these average daily purchases, I showed an example where I might be purchasing a lot more than I'm selling, and that would show up here in the age of the inventory. So if I have on my balance sheet $89,000 worth of inventory and my average daily cost of sales is $1,128.77, then that means I could expect to sell all of that inventory in just under 80 days, 78.8 days. That's not a great number. I'd like for that to be a lot lower. I'd love for it to be closer to like 30. I'd like to be selling, I'd like to have only enough inventory on hand to cover about the next 30 days. That's a much more efficient model than having nearly 3 months worth of inventory on hand. Why would I want to carry 3 months of inventory on hand, which, would be 90 days? So this isn't quite 3 months. If I can get deliveries of inventory every week or at least every month, let somebody else have it on their balance sheet until I buy it. Why would I buy it from them just to sit around in my warehouse? That causes me to have extra warehouse space. That means I've got money tied up in my inventory. So that's not a very good number. In some cases, it might be, maybe I'm a car dealer. Car dealers might have inventory that doesn't turn every month, and they may not be able to get it that quickly. I don't know, but I can think of bigger items, bigger, more expensive items where it having 80 days of inventory might be appropriate, and so yachts or expensive boats. You're not selling a dozen a day or 2 dozen a day or 100 a day. So it might work out in certain industries. So again, all of these are relevant to the industry. So that's how age of inventory works. Generally, lower is better. How about age of receivables? If you have accounts receivable on your balance sheet, what do you think is better? To get that money in the door as soon as possible, or let it sit outstanding in somebody else's bank account for as long as possible? Well, again, you're going to want to collect on your receivables and turn it into cash just as soon as you can. So here we're looking at accounts receivable of $115,000, and we're looking at daily sales of $1,402. So that means we've got 82 days of sales sitting in our accounts receivable. That again is not very good. So we would love to again see that number much lower. Maybe even all the way down to 10 days or 15 days would be much better. 30 days at the tops. 82 days, we're giving very generous terms, and that's just too much. And then finally, we have age of payables. So our accounts payable, we're using somebody else's money. We are able to buy on account. So we have $68,000 of accounts payable, which is equal to 60 days, because our ADP, our average daily purchases, we're purchasing $1,128 a day, and so we have $68,000 of payable. That's 60 days of payables that we have currently outstanding in or sitting in our accounts payable. We can look at this two ways. Number one, accounts payable normally doesn't have an interest rate associated with it. So it's kind of like free borrowing. Occasionally there is if we wait too long to pay it, our vendor might start charging us an interest rate on it, but generally they're not going to charge us until it's 30, 60, maybe even 90 days from the date we purchased on their account. Usually 30 days is kind of the limit. But here we've got 60 days of payables out there. So we're really using somebody else's money for free. And we probably have to because we have so much money tied up in inventory, and we have so much when we're not doing a very good of collecting from our own customers. So we're kind of passing the buck down the field. That's how you would look at this. Instead of just seeing these numbers and going, well, it calculated this. I don't know what that means. What I'm giving you is a way to think about this to better understand what this information is actually telling you if you were going to be managing this business or analyzing this business. And so 60 days of payables, on one hand, it's free money or inexpensive money unless they are charging us interest on it because it's so delinquent. But on the other hand, we might say we're not running the business very well because we don't have enough cash flow to keep our payables current. So normally we'd like to see this number under 30 days. And if I'm analyzing this company and I see that number going from 20 to 30 to 45 to 60 over a period of time, I'm immediately going to have suspicions that this company is having a problem with its cash flow and it's unable to pay its vendors promptly. And if that's the case, guess what? Vendors might start cutting them off. That might lead to other problems. Are they a viable business? Are they even sustainable? So all of this here is representative of a very poorly run company. Just by looking at these numbers, I can tell you this is a poorly run company. And hopefully that's a little more color than you would get just by running the numbers and coming up with some answers and not really knowing what they mean. So let's look at number 6. I hope y'all come back with some questions on this. I hope some aha moments are occurring. I hope some light bulbs are going on. So let's see what 6 has to say. So we're going to revisit something that we studied in the accounting module. We're going to look at the current ratio and the quick ratio. I'm not going to spend a whole lot of time here because we studied this a lot in the first 3 weeks. We know what current assets are. I did modify the current liabilities, by the way, because I think in the problem it just simply gives you a number as being the current liabilities. But to make it, again, a little bit more relevant to what we studied in the accounting module, I simply added some representative current liabilities here, again, just so when you look at it, it's like, oh, okay, now I start seeing, a little bit more clearly. They gave us 3 different current asset figures, but they only gave us current liabilities, I believe, as a total. So I broke it out a little bit, just made up some numbers that would total up to the same. I know in the problem, I think this is actually 48 minus 68 here. And again, just as a reminder, everything that I'm doing, I used different numbers than what is found in your homework set. And so we know how to calculate a current ratio. It's just current assets divided by current liabilities. Everybody did a great job of answering the discussion question around that having more current assets than we do in current liabilities is generally considered a good thing. We like to see this number at least 1.2 times, 1.5 times, up to 2.0 times, or even higher. But, so 1.46, that's not bad. We have 1.46, the amount of current assets as we do those liabilities, remembering that current means coming due within the next 12 months, or being in the asset side, being able to liquidate within or expected to turn to cash within the next 12 months. Good thing. So we look at the quick ratio, sometimes called the acid test ratio, which basically is just current assets minus inventory. The book uses a little bit of a different calculation, and in this particular problem, it doesn't make a difference. But if we had like prepaid expenses, which is an asset in our current assets, the book's definition of current assets is just simply cash plus accounts receivable. Current assets minus inventory gets us the same place with just these three line items provided, and is in fact a little bit more of a traditional measure of current assets. So, or at least the numerator for quick ratio. So taking inventory out of the picture, because it's unclear how quickly we might be able to sell that inventory. So we remove that and we look at the even more liquid assets that we have among our current assets, and we still divide that by the same amount of current liabilities. This generally is below 1 times. If our quick ratio is 1 times or better, we have a really liquid company, which is a great thing. It's not that unusual, but it just really kind of depends on how inventory intensive a company might be. So, this is just something, as we've talked about before, we would compare over time. We might compare with its peers. Just gives us a good idea of how liquid the company is and able to meet its current obligations. Then in 7, all right, so now we're going to be really looking at some kind of like leverage ratios. So way up here, we had a leverage ratio that I had said was a little bit awkward or a little bit unusual because it has assets divided by equity. Well, down here, we're going to be looking at it a little bit differently, where we're going to be looking at debt in relationship to assets. We're going to be looking at debt in relationship to equity. We're going to be looking at debt in relationship to a broader measure of capital. And so, this is a little bit more traditional way to look at leverage ratios. And so, in fact, I'm a little bit surprised here that we don't have a total equity to assets ratio, which is really just the reciprocal of this number. So if debt to assets or 0.57, then equity to assets therefore must be 0.43, because assets equals debt plus equity, right? Liabilities plus owner's equity. And in this case, they gave us, this is a little bit of an unusual terminology. We haven't used this terminology before, where non-interest bearing liabilities or non-interest bearing debt really is what previously we've been calling current liabilities. So we typically think of the current liabilities as not having an interest rate associated with them. So that's what they mean by non-interest bearing debt or non-interest bearing liabilities. It's still something the company owes, but we don't generally have to pay interest on those liabilities or that debt. And it's very short term. Usually these are paid within a week, 2 weeks, 3 weeks, 4 weeks. So interest bearing debt, though, long-term debt, is going to last longer than a year. It's going to be out there for more than a year. And so this non-current debt or long-term debt is interest bearing, and so we're going to look at that a couple of different ways below. But the total debt or the total liabilities of the company is just the non-interest bearing but plus the interest bearing, which previously we've called current liabilities plus non-current liabilities, same thing. And so, looking at our owner's equity, we have A equals L plus OE. A equals L plus OE. And so, That's our little miniature version of a balance sheet there. And so debt to assets, how much of our assets is supported by debt. And so, 0.57, you could say 57% of my assets are supported by debt, or that debt covers assets 0.57 times, either way you want to look at it. And so, in this case, lower is generally considered better, although it kind of goes back to what I was saying earlier as well, that it kind of depends on the company, and each company or each industry kind of has a target range of how much debt they want to use in supporting the assets of the company. Once you get up above 50%, 50% indicates that equity is the other 50%. So once you start having more debt than equity, that's not bad. Sometimes you'll see debt to equity of like 2 times, which is going to be the next calculation. Sometimes 3 times. When you start getting up above 3 times, that's what we consider to be a highly leveraged company. And now you're really getting into a risky area where you're relying on debt to support your assets more than equity by a factor of 3. And that's pretty heavy. But so let me just go ahead and jump on down then and look at that my total debt, and again, this is current and non-current debt combined, of 155 million, as compared to equity of only 117 million. So I have 1.3 times as much debt as I do equity. That's not bad. Again, 2 times is okay, not bad. 3 times is kind of starting to push it, and anything above 3 times for most businesses is pretty risky. I say all of that, but guess what? I'm a banker. Guess what ours is? It's 9 times. And so it's our or maybe even 10 times. In a bank, the debts of a bank are generally 10 times the equity that a bank has. And why is that? Well, it's because our balance sheet is made up mostly of other people's money. When you deposit money in a bank, it's a liability to that bank because the bank has to give it back to you. It's your money. So even though the bank has the cash, it owes you, and it demonstrates that the bank owes you money by showing your account as a liability to the bank. So so banks generally have about 10 times as much debt as they do equity, and that's because they have all of those accounts with them. And so that's an example of an extremely high debt to equity. But most operating businesses, somewhere between 1 times, which would mean that the debt and the equity are about the same amount, up to 2 times, which would be twice as much debt as equity, on up to 3 times, where we start getting into the highly leveraged zone for an operating company. That kind of gives you a sense of what a good number is versus a challenging number. And then we're going to look at long-term debt to capital. Capital is a term that you hear frequently, and it can actually be defined a number of different ways. This is a pretty common and traditional way of just thinking about the long-term debt of a company and the owner's equity. So what we're calling interest-bearing debt up here, only the long-term portion, because this is the operating portion. This is what goes into working capital. This is the long-term portion. This is how I really finance fixed assets, is through long-term debt or equity. So when I combine those two numbers, long-term debt or non-current debt plus my equity, that's that right-hand side of the balance sheet, the non-current portion of the right-hand side of my balance sheet. And so we're going to call that the capital of the company. And so how much of that capital is made up of long-term debt? And so here it's going to be a little bit higher. because it's just calculated differently. But so again, we don't want to see this number to be too high, because that just means that the owners of the company really don't have much skin in the game. You hear that term sometimes, or their own capital at risk, that they're using other people's money, borrowed money, very heavily. And so in this case, 0.65 times is not that bad. If this number, was 1 times or something like that, then it's starting to say that long-term debt is a higher percentage of or in fact that would be zero owner's equity if it was 1 times, because there would be no owner's equity, just be long-term debt divided by long-term debt. So yeah, so in this case, 0.65 times, we'd want to see this number kind of come down, perhaps. So again, this is just a way to kind of look at the solvency and how a company is capitalized, and start thinking about and forming opinions and even making predictions on the performance of the company because of how it's leveraged or how it's capitalized. And then the final problem. This one has a unique twist to it. So here we are going to look at EBITDA. We're looking at EBIT as well, as kind of a starting number. We've got all of this additional information here. We're going to be looking at some coverage ratios. And so coverage ratios are basically, we're going to be looking at a profitability measure. That could be net income. It could be some other cash flow measure, such as EBITDA or EBIT. Could be cash flow from operations, taken off the statement of cash flows. Could be, a lot of different ways that we would have the numerator structure, but it's generally some measure of cash flow. And then in this particular case, this is something that lenders, bankers, and maybe creditors, but or such as vendors, but mostly this is bank oriented, kind of analysis in this one, as well as a manager wants to see that they're not getting dangerously close to not being able to pay their debts. If you get in a situation where you cannot pay your debts, bad things start happening. Like repossessions and foreclosures, so we don't want to see any of that going on. So here, these coverage ratios, higher is going to be better. And so I think the first thing that we have to do in this problem is to take this information that's provided here and to calculate EBITDA or EBITDA, because it's going to be used in the debt service cover. This version of this formula for debt service covers, this doesn't happen to be the one I typically am most familiar with, but it's okay. That they can all be different, and effectively they're going to kind of give the same directional information, and coverage is coverage. And so EBITDA here is, of course, our EBIT, which is earnings before interest and taxes. We're going to add to that depreciation and amortization. We talked in the last video quite a bit about depreciation expense, and that's what this is. Not accumulated depreciation, not accumulated amortization, but the depreciation expense of a period plus the amortization expense of a period. And so the only difference between depreciation and amortization, if you don't already know, so we talked a lot about depreciation being the recognition of the periodic use of a long-term asset. And so I think we had a delivery van that we were using like over, I don't know, 6 years or whatever it was. And so we, divided up that cost of that van by 6 years and reduced the value of that van each year by debiting in depreciation expense and crediting accumulated depreciation van. So we have this depreciation expense every year. So we're adding that back to earnings before interest and taxes. But the amortization piece is the exact same type of account, except for it's related not to a fixed tangible asset. It's not related to a fixed tangible asset. it's related to an intangible asset, a long-term intangible asset. What is a long-term intangible asset? Think about it. Typically, this would be something like trademarks that we have purchased from another company, or patents that we have generated or purchased from another company. So when we have these long-term intangible assets and we reduce their value each year, because a patent only lasts for so long, copyrights only last for so long, trademarks only last for so long. So we reduce that value by the passage of time, and that's called amortization. So functionally, it works just like depreciation. So where depreciation reduces the value on our books of a long-term fixed asset, amortization reduces the value of a long-term intangible asset. So we add depreciation and amortization back to EBIT. Because they've been, shown as a reduction on our income statement. So we're going to gross our net income back up by that amount, and that gives us EBITDA or EBITDA. You can see it's just 85 and 8 plus 86. So we've calculated EBITDA. And so our interest coverage ratio in this version of an interest coverage ratio, we're just using EBIT. And so we've taken our earnings, our net income, and we've added back interest, we've added back taxes, and we get 57,350. And from that, we divide by the interest charges of the period, which were $23,500. And so it's very important to see a high interest coverage ratio. Anything remotely close to 1-to-1 would be a very bad sign. So even 2.44 isn't great, but it's not shocking, it's not alarming. It means, I have earnings before interest and taxes that can pay my interest costs for that period 2.44 times. That's okay. And then I want to look at things a little bit differently because, of course, if I've got long-term debt, not only do I have interest charges, but I've also got principal repayment requirements. I am most familiar with calling that current maturities of long-term debt, or CMLTD. So that's why I have that there. In this particular formula, I want to point out this little footnote that I've added to the bottom, is that current maturities of long-term debt, or those principal repayments of a given year, must be grossed up by 1 minus the tax rate in order to recognize how much pre-tax earnings would be necessary to equal the principal payments required on an after-tax basis. So because we've got EBITDA, this has been grossed up, we need to show our current maturities or our principal repayments as how much that would have been if it was grossed up by the earnings on a pre-tax basis. So it's just a little convention that this particular version of a debt service coverage asks us to do. So I presented it. I don't normally do it this way, but the book is asking us to, so I'm showing you the book method. So we have EBITDA, which is a measure of cash flow, divided by the interest expense for the period plus this grossed up version of principal repayments or current maturities of long-term debt, which you can see up here in the formula. I think this is on the screen as well, being recorded. You can see I'm grossing it up by 1 minus the tax rate. The tax rate here is what's found in cell D89. So 1 minus 0.3 or 35%, 1 minus 0.35. So I'm dividing my current maturities of long-term debt, which is in D88, by 0.65. I'm grossing it up. And so that's where I add that to interest expense, and I use that as the denominator. And I'm able to cover that amount with my EBITDA 1.74 times. That's pretty strong. Anything north of 1.3 or 1.2, 1.3 is considered good. That's kind of the lower end of where I want to find myself operating. It doesn't give me a whole lot of cushion. If times get a little bit lean, I'm going to be down to 1.0 very quickly and might find myself below 1.0, which is obviously bad. That means I don't have enough cash to pay my debt payments. Bad things are going to happen. So, if I'm a conservative business person really wanting to run my company without much risk of being able to make my debt service payments, including interest and principal, then I'm probably going to want to see this somewhere around 1.3 or probably more like 1.5, 1.74. I'm feeling very good about that. If I'm able to maintain that level time in and time out, what that tells me is I have a little bit more borrowing capacity. I could take on more debt. A company that has that flexibility, that's strong enough to take on more debt, can seize opportunities that other companies cannot. It can weather difficult times better than other companies with no coverage or little coverage ratios. So again, just an insight on how to think about that. And that brings us to the end of these problems. I hope you find this helpful. Um, I'm wrestling with putting this worksheet out there or not. I think I will provide you with this worksheet, except for I'm going to take out all the numbers. Maybe I'll even take out the formulas. So I'm going to give you this worksheet in some form or another, because I really want you to focus on not just being able to crank out the ratios, but I want you to be able to think through them and explain them and understand what they mean. So there's really kind of two sides to this whole exercise. And so in any case, hope you've enjoyed this lesson. Hope you've gotten something from it. I look forward to your questions. I look forward to grading your homework, and enjoy the rest of your weekend.